Have you ever wondered why sometimes gold suddenly crashes? Or why the stock market feels strong one day and weak the next? And behind all of it, there's one invisible force quietly controlling everything: the US dollar index. Most people don't even pay attention to it. But the truth is, if you understand how the dollar index moves, you start seeing the entire financial market differently. And once you see it, you can't unsee it. Imagine this: a single number moving up or down. And because of that, currencies shift, gold reacts, oil changes direction, and even global economies start feeling pressure. Sounds powerful, right? That's exactly what we're breaking down today in a simple way. So by the end of this video, you'll not only understand the US dollar index, but you'll start predicting how markets react to it. And before we go deeper, if you're someone who wants to understand gold, currencies, and smart money movements in a simple way, make sure you hit that like button and subscribe to the channel, The Gold Report. Because here we break down complex financial concepts into clear, real-world insights that actually help you think like smart money. Now let's get into it. The US dollar index, often called DXY, is basically a measure of how strong the US dollar is compared to a group of major currencies. Think of it like a scoreboard. When the score goes up, it means the dollar is getting stronger. When it goes down, the dollar is weakening. But here's where it gets interesting. This is not just about the dollar itself. It's about global power, trust, and money flow. Because the US dollar is still the world's reserve currency, its movement affects almost everything. Now you might be thinking, okay, but what actually makes it move? This is where the real story begins. The movement of the US dollar index is driven by a mix of factors. And once you understand these drivers, you start connecting dots across the entire market. One of the biggest factors is interest rates. When the Federal Reserve raises interest rates, the dollar usually becomes stronger. Why? Because higher interest rates attract investors. People from all over the world want to park their money in US assets to earn better returns. That increases demand for the dollar. And when demand goes up, the price goes up too. Now flip the scenario. If interest rates go down, investors start looking elsewhere. Demand for the dollar drops, and the dollar index falls. But it's not just about rates. It's also about expectations. Sometimes the dollar starts moving even before the Fed makes a decision, because the market is always trying to predict the future. And this is where smart money plays the game. Let's say investors believe inflation is rising in the US. They might expect the Fed to increase interest rates soon, so even before the actual rate hike happens, the dollar starts gaining strength. Now think about how powerful that is. The market doesn't wait for news, it moves on anticipation. Another major factor is economic data. Things like GDP growth, employment numbers, inflation reports. All of these influence the strength of the dollar. If the US economy looks strong, investors gain confidence. More money flows into the US, and the dollar rises. If the economy looks weak, confidence drops, and the dollar weakens. Now here's where it connects directly to gold. Gold and the US dollar index usually move in opposite directions. Not always perfectly, but most of the time. When the dollar gets stronger, gold becomes more expensive for people using other currencies. So demand for gold drops and prices fall. But when the dollar weakens, gold becomes cheaper globally, demand increases, and gold prices rise. And this is why traders who understand the dollar index always keep an eye on it before making decisions in gold. And this is exactly what we focus on here at the Gold Report. Connecting these dots so you're not trading blindly. Now let's go a bit deeper. There's something called safe haven demand. When there is uncertainty in the world, like geopolitical tensions, wars, financial crises, investors look for safety. Sometimes that safety is gold, but sometimes it's the US dollar. And when the dollar becomes the preferred safe haven, the dollar index rises sharply. For example, during global uncertainty, even if the US has its own issues, investors still trust the dollar more than other currencies. That's why you'll often see the dollar index spike during times of fear. Now here's a subtle but important detail. The dollar index is not measured against all currencies equally. It has a specific basket, and the euro makes up the largest portion of it. So when the euro weakens, even if nothing major is happening in the US, the dollar index can still go up. That means sometimes the dollar isn't getting stronger. Other currencies are just getting weaker, and that's a key insight many beginners miss. Now let's talk about market psychology. Markets are driven by emotions just as much as data. Fear, greed, uncertainty, all of these play a role. When traders feel confident, they take risks. Money flows into stocks, emerging markets, and other assets. In this environment, the dollar might weaken. But when fear enters the market, money pulls back. Investors move into safer assets, including the dollar. And that's when you see the dollar index rising again. So the movement of the dollar index is not just about numbers, it's about human behavior. Now imagine combining all of this knowledge. interest rates, economic data, global events, market psychology, all working together to move one index. And once you start watching it daily, you begin to understand market direction before it becomes obvious. This is where real edge comes from. Now let's talk about trends. The dollar index doesn't just move randomly, it forms trends, just like any other market. There are bullish phases where the dollar stays strong for months, sometimes even years, and there are bearish phases where it gradually weakens. During a strong dollar trend, commodities like gold and oil often struggle. During a weak dollar trend, commodities tend to perform better. So, if you're a trader or investor, identifying the trend of the dollar index can completely change your strategy. Instead of reacting late, you start positioning early, and that's the difference between average traders and smart money. Now here's something even more interesting. Sometimes the dollar index and gold move together. Yes, it happens, but usually there's a specific reason behind it. For example, during extreme uncertainty, both gold and the dollar can rise at the same time because both are seen as safe havens. But these situations are rare and usually temporary. Most of the time, the inverse relationship dominates. Now let's bring this into a real-world mindset. Imagine you wake up and you see the dollar index breaking a key resistance level. At the same time, economic data is strong and the Fed is hinting at higher interest rates. What does that tell you? It tells you the dollar might continue strengthening. And if the dollar strengthens, what happens to gold? It likely faces pressure. This is how professional traders think, not just looking at one chart, but understanding the bigger picture. And once you train your mind this way, your decision-making becomes sharper. Now let's talk about timing. Understanding the dollar index is one thing, but knowing when it will move is another. Major movements often happen around news events, Fed meetings, inflation reports, employment data. These are moments when volatility increases, and the dollar index can make strong moves. So if you're watching the market during these times, you get valuable clues. And over time, you start recognizing patterns. Now here's the most important part. You don't need to predict every move. You just need to understand the direction. Because when you align yourself with the direction of the dollar, everything else starts making more sense. And this is exactly what we aim to do on the Gold Report. Simplify the market so you can think clearly and act confidently. Now, as we're getting close to the end, think about this. Most people jump into trading without understanding the forces behind price movements. They look at charts, indicators, signals, but they ignore the bigger driver, the US dollar index, and that's why they struggle. But now, you're not in that category anymore. You understand what moves the dollar. You understand how it connects to gold, and you understand how global events influence it. That puts you ahead of the majority. And if you found this breakdown helpful, drop a comment below and tell me, do you currently track the dollar index before trading gold? Or is this something new for you? Also, share this video with someone who trades but still struggles to understand market direction, because this one concept can completely change how they see the market. And don't forget to subscribe to the Gold Report, because we're just getting started and there's a lot more coming that will sharpen your market understanding even further. I'll see you in the next one.